Welcome to Illuminati Silver. We tell you the truth about silver. Today is Saturday the 3rd of July 2021 and we're looking at a Bloomberg article published today where a member of the European Central Bank warns that inflation is higher than reported and it is most certainly not dead. So let's take a look. So let's take a look at this article dated today, July the 3rd. Under the headline of ECB's Not warns central bank could be underestimating inflation. Now we all know that central bankers have set target rates for inflation, generally at or around 2%. As far as the United States is concerned, Europe and the United Kingdom, similarly in other parts of the world as being the ideal target range. All of them, however, accepting the fact that certainly this year that rate will be exceeded, but a number of them stating that it will only be transitory and will become self-correcting with the policies that they have in place. We have doubted that from the very beginning, but equally we haven't necessarily advocated that some alarmists have that inflation is going to hyperinflation anytime soon. However, that said, if the central banks are underestimating inflation, almost regardless whichever percent they're underestimating it by, that could have quite a profound effect on its ability to start to keep rates as low as possible to gain maximum advantage in terms of employment and economic activity, and may find themselves having to taper their bond buying program much sooner rather than expected and raise interest rates as well. Let's have a look at this article and we'll comment as we go through it. European Central Bank policymaker Klaas Knot warned that policymakers may be underestimating the potential for accelerating inflation to become entrenched and that emergency monetary stimulus should end around March 2022. While the ECB predicts that current elevated inflation rates are temporary, driven by rebounding energy prices and supply shortages as the economy reopens, the Dutch central bank governor said the outcome may be different. We should not overestimate our capacity to determine in advance what is temporary inflation and what is not, he said in an interview with Dutch newspaper NRC. There are other scenarios conceivable than our base case of persistently low inflation. Inflation is not dead. The ECB is expected to debate the future of its €1.85 trillion or $2.2 trillion pandemic bond buying programme after the summer, with some on the 25-member governing council worried that monetary support will be pared back too soon. Knot said he has doubts about the central bank's activist use of its balance sheet as a policy tool, and that he regularly expresses that sentiment in policy meetings. It is good that we acted quickly in this crisis, he said. But as soon as the fire is under control, the fire brigade has to return to the barracks. That should be the case around March 2022. The Dutch governor, who also said he might not have backed negative interest rates in 2014 if he'd known how long they would last, said his views on inflation were influenced by his conversations with officials who experienced the 1970s. He is a member of the Group of 30, a gathering of mostly former central bankers and policymakers. He noted rising house prices as one sign of perceived price pressures and called for tighter lending standards in the Netherlands. Real estate was the most popular discussion when the Dutch Central Bank held a listening event with citizens and civil society groups as part of the ECB strategy review. That review is studying how to better reflect the cost of home ownership in its measures of inflation, and Knot said he backs a change. We as central bankers complain that inflation is too low, but when you talk to people in the country, they say that everything has become so terribly expensive. And then you ask them, what has become so expensive? And then they say, my housing costs, he said. And then we say, sorry, but that's not in our index. Of course, that cannot be true. And this is really the nub of the problem. It is very easy for us to criticize economists, central bankers, in their assessment and delivery of economic figures. Sometimes it is deserved and sometimes it is not. Very often they are attempting to actually provide as accurate a figure as they can, albeit the politicians perhaps not desiring that. Generally speaking, there will be one or two exceptions, but generally speaking, it doesn't make that much difference to the central bankers, personally at least. There might be political pressure, but certainly from their own perspective, they're wealthy enough so that whatever figures they produce isn't really going to have such an adverse effect on them personally. But that said, we're all aware that inflation targets and assessments have changed over time, has differed, been amended and altered, and very often in the past, particularly when politicians have had control over central finance to suit their own agendas. On the back of this, we also have the ECB to hold special strategy meeting next week, OMFIF says. European central bank policymakers will hold a special meeting in Frankfurt next week in a bid to wrap up the institution's strategy review, according to OMFIF. The gathering is expected to put the finishing touches on a new definition of price stability, wrote David Marsh, chairman of the Official Monetary and Financial Institutions Forum, which is what OMFIF stands for, a think tank for economic policy. The meeting is expected to start with a Governing Council dinner on Tuesday and could extend through Thursday. Be interesting to see what social distancing is carried out there. Marsh wrote, adding that an announcement may be made afterward if agreement can be reached. An ECB spokesman said the institution has planned several meetings that might be held in person if health and safety regulations allow, while declining to comment directly on the OMFIF report. The strategy review has been running since early 2020, though it was disrupted by the pandemic, and is studying a broad range of topics such as inflation, something we just mentioned, employment, climate change, which is ever growing in importance in terms of investment, green energy, etc., and fiscal policy. There's broad consensus that the current inflation target of below but close to 2% should change. Interesting. But disagreement on what should replace it. Some favour a precise goal of 2%, with flexibility to reach it, and some, especially from Southern Europe, want an explicit pledge to tolerate higher rates after shortfalls. In other words, to give over time an averaging out. Bundesbank President Jens Weidmann said late Thursday he supports an explicitly symmetric formulation of our policy goal on an inflation rate of 2% over the medium term, but that he's not convinced by average inflation targeting. Inflation targeting has been adopted by the Federal Reserve and allows for looser monetary policy to let price growth run above the goal to make up for previous undershoots. Weidmann said it could be interpreted as keeping interest rates low so that governments can afford their debt burdens, which could undermine credibility. To keep still when the inflation rate exceeds the target over the medium term could be misunderstood as an expression of fiscal dominance, he said. The meeting next week would come on the heels of a recent retreat by the 25-member Governing Council near Frankfurt. Officials made good progress there in shaping the institution's future monetary policy, President Christine Lagarde said last month. The discussion, while not a formal monetary policy meeting, may also shape the ECB's plans for when and how to exit the emergency measures it's deployed during the pandemic. Its €1.85 trillion bond buying programme is currently set to run to at least March 2022. So there we have it. Fiscal stimulus, the QE programme, by want of another name, will be reviewed in Europe by March 2022. We've already heard the Fed claim that they may very well be cutting back their QE programme before then, or at least having talks, to be more precise, about that well before then. And the UK already indicating that due to its rise in inflation, it may very well curtail its QE programme sooner than expected. What do you think? Do share your thoughts. Clearly, once tapering takes effect, that will certainly have some form of downward pressure on gold and silver prices, but it may also reflect a growing economy, which should certainly for silver prove advantageous. We shall have to wait and see. But we know we're all to some extent being deceived by official figures, whether by intent or whether by accident, regardless. Those who live in the real world are aware that inflation is higher than what the official figures report. What can be done about this? How should they be altered? Do share your thoughts. Thank you so much for listening. Please give us a thumbs up, subscribe to the channel, and press the bell sign. And most certainly, share your views with us below. This morning, we published our gold and silver weekly update, and we've provided a link to that also in the description box below. Disclaimer. Illuminati silver owners come from a background of banking, international wealth management, and economics. Having now retired from these worlds, we are not qualified to give investment advice. Therefore, this and other productions must not be deemed to be giving such advice and merely represent the personal views of its owners.